In the early 2000s, Wall Street believed one thing. WorldCom was still strong, still profitable, still unstoppable. But behind closed doors, inside quiet accounting offices in Mississippi, the numbers were fake. Not exaggerated, not aggressive, flat out manufactured. This is the real story of WorldCom. How executives rewrote reality. How one internal audit team uncovered the truth. And how the largest accounting fraud in American history collapsed under its own lies. This is not just a corporate scandal. This is a case study in how financial systems fail from the inside. Welcome to Deception Reports. WorldCom didn't start as a villain. It started as a telecommunications success story. Through aggressive acquisitions, including the massive purchase of MCI in 1997, WorldCom became the second largest long-distance phone company in the United States, Spynet. DID. By the late 1990s, WorldCom controlled global fiber networks, served millions of customers, and carried Wall Street's expectations quarter after quarter. The stock market loved growth, and WorldCom delivered, or at least that's what the numbers said. But growth came with a problem. The telecom boom was slowing. Competition exploded. Prices dropped. Usage didn't meet forecasts. Revenue stopped growing. Wall Street didn't care why. They only cared that earnings kept rising. That's when the fraud began. By 1999, WorldCom was under intense pressure to meet analyst expectations. CEO Bernard Ebbers had borrowed heavily using WorldCom stock as collateral to finance personal investments. A falling stock price wasn't just bad optics. It was financially dangerous. Inside WorldCom, the message was clear. Make the numbers work. Not legally, not transparently, just work. Instead of cutting costs or admitting losses, executives chose a different path. They changed how expenses were recorded. Here's the core fraud, and it's brutally simple. WorldCom had massive line costs, fees paid to lease telecom network capacity. These are operating expenses under GAAP. They must be recorded immediately. But expenses, lower profits. So executives did something illegal. They reclassified expenses as assets. Instead of hitting the income statement, costs were moved onto the balance sheet, pretending they would provide future value. They called this fake category prepaid capacity. It wasn't a real accounting concept. It wasn't supported by GAAP, and most accountants processing the entries didn't understand it. That was intentional. In December 2000, Kim M.I., a financial analyst, was told to capitalize labor costs that should have been expensed. He knew it was wrong, Ebbers Bach. He escalated. He warned management. Within 24 hours, the directive was quietly withdrawn. But M.I. paid the price. He was reprimanded, and by March 2001, he was laid off. This is important. The system didn't reward honesty. It removed Italiano. In 2002, an internal audit manager named Glenn Smith read a small local newspaper article mentioning suspicious spending at work. He brought it to his boss, Cynthia Cooper, Vice President of Internal Audit. She didn't ignore it. She accelerated a scheduled audit. That decision would end WorldCom. When Cooper's team began digging, they encountered resistance immediately. Executives questioned the audit. Servers slowed. Access became difficult, so the audit team did something extreme. They worked at night to avoid detection. Using basic accounting tools and simple T accounts, they traced transactions. What they found was damning. Money was being systematically moved from expenses to assets, quarter after quarter. By Q1 2002 alone, a reported $130 million profit was actually a $395 million loss. The company wasn't just overstating earnings, it was lying about reality. When questioned, accountants admitted they didn't understand the entries. Managers admitted they booked them on instruction. Controller David Myers admitted there was no support. CFO Scott Sullivan admitted the goal was to hit margins. One statement says, everything. We booked it based on what we thought the margins should be. That's not accounting. That's fraud. By June 2002, Over $3.8 billion in fake entries were confirmed. Later, expanded to over $11 billion, the largest accounting fraud in U.S. history at the time. External auditors confirmed. There was no GAAP justification. The only purpose: meet Wall Street expectations. The board demanded resignations. Sullivan was fired. Myers resigned. Earnings were restated. The illusion collapsed instantly. Once the truth became public, stock collapsed over 94%. Credit rating fell to junk. 17,000 employees were laid off. $30 billion in debt surfaced. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy. A telecom giant was gone. Not because the business failed, but because the numbers were fake. The SEC charged WorldCom with fraud. In 2005, CEO Bernard Ebbers was convicted of fraud, conspiracy, and filing false statements. Sentence: 25 years in prison. He was released in 2019 due to health issues. He died in 2020. Too late for employees. Too late for investors. WorldCom didn't just collapse a company. It helped trigger the Sarbanes-Oxley Act, stronger internal controls, and corporate accountability reforms. But here's the uncomfortable truth. The fraud wasn't complex. The warning signs were visible. People spoke up and were silenced. WorldCom didn't fail because no one knew. It failed because power chose deception over truth. If you think this could never happen again, you're wrong. The names change. The tactics evolve. The incentives stay the same. That's why stories like WorldCom matter. Subscribe to Deception Reports for real financial crime stories, told without excuses, without myths, and without mercy.